Okay, looks like a couple of people there have now filtered in, so I'll make a start. Hello and welcome to GetGround's first webinar of the year, actually, which is titled "Property Investment Still Leaving You Lost." I am one of your hosts today. My name is Joseph Carbonaro. I am the head of consulting here at GetGround, and I'm going to be talking to you about limited company structures. So a lot of people have quite a lot of confusion at the moment, I suppose, on whether a limited company structure is going to be the right way for them to go, or whether we should buy in their personal name. So some of the themes that I'm going to be talking about today are really along the lines of what are the benefits, perhaps what are some of the drawbacks, of that structure. And then for the second half of the webinar, which will kick off just after 1 o'clock, I'll be handing over to Pat Rajcharian, who is our head of financial products here at GetGround. So just to give you a little bit of background on myself, I've been working in real estate and financial services for just under 10 years. I've worked for some of the largest property developers here in the United Kingdom, specifically in Manchester, Liverpool, Leeds, and some of the more emerging markets here in the UK. And now my specialization is limited company structures since joining GetGround. Brilliant. So a couple of things that I do need to make you aware of before we get started. GetGround, we are authorized by the Financial Conduct Authority here in the United Kingdom, specifically for the sale and transfer of unlisted shares. And that's something I'm going to be talking to you about a little bit later on. We are registered with the Information Commissioner, and we will keep your personal data protection, protected. We are the recommended supplier for limited company creations for the NRLA, the National Residential Landlords Association. And we have also taken a direct capital investment from the UK government as well, which is pretty cool. So some of the things there around our kind of regulation, so to speak. So just a little bit about GetGround, just as a refresher if we've not had a chance to speak to you in a little while. If you were to set up a limited company structure yourself, you would typically need some help. So the vast majority of people want accountants. They might need a company creation agent, a tax advisor. They might need assistance from a company secretary, a lawyer to put in the legal documentation. They might need help from a mortgage broker, and so on and so forth. So whenever you have 3, 4, 5 separate parties involved in any one transaction, it can obviously become a lot of hassle and naturally very expensive. So here at GetGround, we want to enable people the ability to set up and structure a limited company without the hassle and the high fees that are typically associated with doing it. So we essentially try and set up a perfect buy-to-let company, or a company that is specifically tailored for buy-to-let. We don't do anything else, in a very cost-effective way. And I'll talk to you a little bit about that as we go. So some people have said that this is a little bit cliche as a statement, but essentially we are a one-stop shop. Everything that you would require in order to set up, structure, and do the ongoing management and accounting of limited companies for buy-to-let. So that includes setting up the limited company, and putting the correct legal documents into place. And I'm going to be explaining some of those a little bit to you later on. We'll provide a company account for the deduction of your business expenses as well. And then in terms of everything that we would typically do would be for the ongoing management and accounting of the company structure as well. We do have some additional services, so the ability to sell through way of shares as well, which I'll be talking to you about a little bit later on. But it comes back to the ability to purchase a property in the correct way through a limited company without the hassle and the high fees typically associated with doing so. So we often, actually for context, when we first sort of came up with the idea for GetGround, we wanted to work out what the best way of purchasing a limited company, or purchasing a buy-to-let property would be. And we got together with some of our partners, so representatives from the UK government, representatives from big accounting firms, taxation advisors, our venture capital partners, etc. And we came to try and answer what we thought would be a pretty simple question, which is, what is the best way to buy a buy-to-let? And of course, it is very, very circumstantial. That is not an easy question to be able to answer at all. So we needed to focus on a number of things. How do we buy a buy-to-let property and take as much profit from that buy-to-let as is possible? How do we extract as many pennies as possible from that investment property? The next thing is, how do we get as much flexibility with what we can actually do with a property whilst it's contained within a limited company structure? And I'll elaborate on what that means shortly. And the final thing is, how do we limit our personal level of risk when we buy a property? Because as we know, even though investing into property, generally speaking, is low risk, it would be a mistake to assume that there is zero risk involved. And I'll talk about that in just a second. So we essentially distilled our methodology down to a number of things. And those that are in regular contact will know that we now have thousands and thousands of limited company structures, or customers, I should say, on our platform, and just under £1 billion in terms of the total value of all of the property that's on our platform. And we distilled our methodology down to 3 things. The first is, we advocate for 1 property per limited company. Okay. And I take it a lot of people that will be on here now are probably sitting, okay, well, why do you do that? That's not what I've seen on YouTube or whatever it is. And please bear with me, I'll come to that. The second thing is a comprehensive suite of legal documentation. So things like a shareholders agreement, an owner's loan as well, which I'll talk to you guys about in just a second. And the final thing is, we believe that it's not enough just to have, say, a bookkeeper or an accountant run the accounts of a limited company. We believe that that doesn't get people the maximum amount of utility from a corporate structure. So we've also created a technological infrastructure, a really awesome online platform around the companies that we create in order to get the maximum value from those. And I'll be explaining a little bit more about that as we go. Now, when you do those things, just to recap, 1 property per limited company, a full and complete suite of legal documentation, and the technological infrastructure around the companies that we create, you actually unlock the maximum potential benefit of a limited company structure, specifically for a buy-to-let. And there's 5 things there that you must be aware of. The first is tax efficiency. So everybody's heard of this, but very few people actually understand what this means. So I'm just going to park that for a second, and I'll talk about that on the next slide. First thing it's worth discussing, therefore, is limited personal liability. So as I just mentioned, whenever we go out and we buy we make any investment for that matter, it could be stocks and shares, it could be properties, it could be Bitcoins, whatever it is, there are typically risks associated with doing so. Now, the good thing about real estate is that, generally speaking, it's considered very, very low risk. Certainly compared to more complex financial instruments. But there are risks that you need to be aware of. They are typically twofold. The first is a financial risk. So to give you an example of a financial risk, and please excuse me, this is a little bit tenuous, but you have a mortgage on a property, a tenant stops paying the rent, you default on the loan, and the property is repossessed. A little bit tenuous because, of course, you guys are all particularly diligent, you'd have insurance for that kind of thing, but nonetheless, that does articulate an example of a financial risk. The second type of risk is a physical risk. So this could be you buy a brand new property and a wall falls down, a boiler breaks. A slightly more topical example of a physical risk is the cladding scandal. So these are examples of a physical risk. Now, we believe that it is very, very, very important for people to isolate the risk associated with each individual property that they buy from A, your personal property, your own house, your own car, B, the other buy-to-let properties within your portfolio, and C, your trading business if you have one. So the concept of one property per limited company is just one of a number of reasons that we recommend because it isolates the risk associated with that one buy-to-let from every other part of your life. Okay. Now, the next point is buy and sell property easily. And I think this should really read increased flexibility. And I'll give you a personal example. So I have a young son, 3 years old, very, very chatty at the moment, a little bit naughty as well. And if I went out and bought a buy-to-let and I wanted to gift that buy-to-let or give that buy-to-let to him, if I bought that buy-to-let in my personal name, the process of doing so is phenomenally legally restrictive. It's not impossible, but it's virtually impossible to do so. However, if I had that property contained within a limited company structure with, say, 100 shares, shares within the eyes of the UK legal system are treated much like cash, meaning that it can be gifted. So I could gift 1, 5, 10, or all 100 shares to my son, provided, of course, he was over the age of 18, at any time without restriction. Okay. Now, there are some taxation implications to doing that, but the point remains that I have a flexibility with what I can actually do with my property portfolio that buying it in my personal name just wouldn't have been able to give me. Okay. Which brings me on quite neatly to the next point, which is estates and inheritance planning. So limited company structures can help to mitigate against a lot of the associated costs and a lot of the associated difficulties around inheritance tax planning. And I'll give you an example of this. So we had a gentleman not so long ago who wanted to buy a buy-to-let property to supplement his income in retirement. But he wanted to make sure that he had as much flexibility with how he transferred that asset onto future generations as possible. So he set up a limited company structure, 100 shares. He gave himself 1 share and a directorship, and he gave his wife 1 share and a directorship. He gave his 2 grandchildren 49 shares and 49 shares respectively. And then he made something called an owner's loan to the limited company structure, which I'll explain a little bit more about when we talk about tax. Now, the benefit of that is that whilst he is alive, he can take all of the rent from that property, if he chooses, as repayment of that owner's loan, which means that all the rent, therefore, will go back to him. But when he passes away, and it's time for the grandchildren and the lawyers to look at the estates and inheritance liability, he only owned 1 share in that limited company structure. So the children's inheritance tax, if anything, is 40% of his 1 share instead of 40% of the property price. So as you can see, using limited company structures does help to give you a lot of the associated flexibility and a lot of the cost saving measures, particularly relating to inheritance tax planning. And the final thing is that roughly 60% now of all buy-to-lets here in the United Kingdom are bought through limited company structures. And there was roughly 45,000 of those done last year, which means that it is the fastest growing sector of the mortgage market here in the UK. Now, limited company rates can be a little bit higher, which is one potential drawback of limited company structures. And Putt is going to talk to you a little bit about that later on. For most people, that doesn't actually mean a barrier to entry, but it is just one of the things here that you do need to be aware of. Okay. Now, what we've just talked about there, so limited liability, increased flexibility, the estates and inheritance planning aspect, as well as a well-developed mortgage market, are some of the non-tax benefits to limited companies. Okay, so whenever you hear limited company structures, please be aware that the benefits are not just tax related. But of course, that is very much what you guys are here to learn. So let's have a chat about it. And I hope you guys have all had a tea and coffee this morning. Tax is never the most interesting thing to be discussing, but let's give it a shot. So the best way to talk about tax is to quite literally compare buying property in your personal name versus buying property in a limited company structure at the 3 different stages of your investment property life cycle. So when we buy the property, when we are operating or renting the property out, and when we sell. Okay. Now, the first thing is when we buy a property. So everybody knows it. Everybody is very, very aware of stamp duty. Okay. The good thing or the bad thing, dependent on how you're looking at this, is stamp duty, or if you're in Scotland, land-based transaction tax, is the same regardless of whether you buy in a limited company structure or whether you buy in your personal name. Okay, £5,000 here, £5,000 there. Okay, there doesn't seem to be any perceived benefit from having a limited company structure in that way. Where the benefit really kicks in is when we own the property. And the first is quite literally the difference between paying income tax and corporation tax. All right. So here in the United Kingdom, income tax, 0 to £50,000, or just under £50,000, I should say, is what we call the base rate, which is 20% of your earnings. If you're earning over £50,000, then your tax rate will be 40%, and over £150,000, you'll be in the additional rate. People here in the United Kingdom also do get some personal allowances as well, and you should check whether personal allowances apply to you. With a limited company structure, any company currently that turns over less than £50,000 is taxed the small business rate, which is 19%. Okay. However, anything that represents an expense when talking about a limited company structure, so to give you an example of what that might look like, ground rent, service charge, property management fees, maintenance charges, and of course the big one, the very topical one at the moment, interest on your mortgages, is a tax deductible. Okay, which means it can be paid before that income becomes liable for tax. So to articulate that in really, really simple terms, you've got £100 a month coming in. All of your expenses, so your fees and your charges, as well as your mortgage interest, equal £40. The income that is liable for that 19% incorporation tax is the £60 that remains. Okay, so using a limited company structure can put us in a significantly better taxation position, particularly if the opportunity cost of that is the high rate of income tax, which is 40%. Okay. The next thing is we've got more ability for how we extract income from a limited company structure. So the first thing is a dividend. A dividend is simply a profit payout from a corporate structure. Everybody here in the United Kingdom gets £2,000 a year from all of the companies that they are a shareholder in as a dividend tax-free allowance. So what that means is if yourself and maybe a spouse or a partner are both owners in a corporate structure, just one corporate structure, you can each take £2,000 out every year as a dividend tax-free allowance. Okay. After that, there is a dividend rate that applies, and it would be up to you to work out where you sit in, but we're not going to discuss that today. What a lot of our clients do is they switch after that to a method called an owner's loan repayment. So an owner's loan is when we create a brand new limited company structure, it's a legal entity in its own right. And of course, it has no money, meaning it cannot go out and buy a rental property. So in order for the company to go out and buy that rental property, it needs to borrow that money from you personally. So we lend our money, which is usually for the deposit, to the limited company structure, and that forms a debt. A debt, of course, that must be repaid to you. So you then go out, buy the property in the limited company structure and start renting it out. Any money that comes in, okay, or any money that you want to take out after corporation tax as an owner's loan repayment is tax-free and doesn't contain any further taxation liability. Okay, which is great, because what that means is you can effectively be in a position where the only taxation that you need to be aware of or you need to be concerned about is 19% incorporation tax. Okay. Additionally, and it isn't actually on this slide, I must get this added, is if you are a UK resident, we can move £10,000 per year, per director, per company, to a pension pot as an expense to your company, and therefore completely tax-free. Okay, and that's called a director's pension contribution. And of course, those three mechanisms for taking money out of a company structure can be mixed and matched depending on what best suits your scenario. Okay. Now, when we sell a property, okay, we have capital gains tax. Capital gains tax is a tax that we pay on the profit that we make when we sell, and it corresponds to your income tax banding. So if you're in the base rate, it will be 18%. If you're in the high rate, it will be 28%. Now, earlier on, I mentioned that here at GetGround, we're creating a technological infrastructure to help you run these company structures. And we're also regulated by the Financial Conduct Authority, specifically for the sale and transfer of shares. So very, very shortly, in the not too distant future, we are going to be creating a marketplace to help you sell your limited company via way of selling the shares in the company that owns the property. There are two big benefits to doing that. The first is a reduction in the amount of capital gains tax that you have, 10% instead of 18% in the base rate, or 20% instead of 28% at the high rate. Okay. And furthermore, anyone who buys that company structure from you will not pay stamp duty on the purchase because they're buying a corporate structure, company structure, instead of a property in its own right. Now that can create something called a price advantage. So if we took an example of a £500,000 property and you were selling that £500,000 property, the stamp duty liability would be roughly £40,000. And of course, stamp duty, as we well know, must be paid in cash. Therefore, if you can offer someone the ability to buy that company structure instead of the property, which would save them £40,000 in cash, you'd be well within your rights to ask them to buy the company structure from you for £520,000, which results in a win-win situation. They can add the additional £20,000 to the mortgage, but that saves them £40,000 in cash. You pay a lower rate of capital gains tax for the sale of a company, and you get a higher price for the sale of the company itself. Okay, so all of these benefits can tot up to effectively mean a significantly higher post-tax profit. And again, a lot of this is going to be dependent on you as a circumstance. But again, to give you an example of this, we've assumed here that this is an investor, UK resident, but taxed at the higher rate in England, so paying 40% in income tax. They purchase a property for £500,000 and produces a gross rent, so pre-tax, pre-expenses, of £20,000 a year. The investor uses a 70% loan to value, so their deposit is 30%, and that's an interest-only mortgage with a rate of 3%. The property's value goes up by 3% a year and is sold after 5 years. Now, in that scenario, somebody who buys that property in their personal name would make just over £32,000. Someone using a corporate structure but selling the property the normal way, so selling the property out of the company and then liquidating the company, would make roughly 20% more than that after everything is said and done. And someone who has the ability to sell the shares in that limited company structure could be as high as 65, 66% better off than someone who's attempted exactly that same exercise in their personal name, which, as I'm sure you can appreciate, is a huge, huge uplift in the amount that you can make. All right. So what do we charge for this service? So if you are a UK resident, we charge £149 plus tax to set up and structure the company, as well as putting the bank account into place. All right. That cost is a little bit higher if you're an overseas resident. That's $499 plus VAT. And that's because of some of the extra due diligence that we've got to do on you as a person and where your funds are coming from. The cost to run the company structure is charged as a monthly subscription, which is £20 a month plus VAT. So £24 a month, which is considerably cheaper in a lot of cases than using a bookkeeper, as well as having all the additional functionality that comes with that. Okay. So we have programmatic web filing, which means that we are directly linked to UK Companies House. We have the ability, therefore, to do things like automated share transfers. We have internal company secretarial tools to help manage these company structures that we create at scale. And it's a really, really innovative product that we have here with a very wide range of functionality. All right. So I hope that's been interesting. A little bit of a crash course in setting up, structuring, and managing limited companies. If you'd like to get into touch with me personally, perhaps there's some questions that you'd like to ask, please do feel free to get in touch. They are my details. And the slides will be sent around to all of the participants as well slightly later on. So don't worry about scrambling to take a picture of this or anything. We will actually send these slides out to you slightly later on. Great. Well, look, thank you very much for listening. I will take a couple of questions now, if there are any. Harry, are there any questions there that you have come up or that I haven't answered?
So would you mind just going through whether or not we can take on a pre-existing company onto the platform?
Yeah, that's a great question. At the moment, we don't have the functionality to do this. The reason for that is the companies that we set up are quite highly tailored in terms of their structures, so the amount of shares that they have, the legal documents that come with them, and the fact that there's only one property inside it, which makes it very, very easy for us to be able to sell those company structures on later on. That being said, we are, of course, working on the functionality to be able to do that. Now, I wouldn't want to commit to a definite timescale for that, but what I would say is please do watch this space because it's something that we are absolutely working on and hopefully will be a very real functionality in the not too distant future.
Fantastic. Thank you, Joe. That is all for the questions.
Brilliant. In that case, I will hand over to our resident expert on the financial side. I'd like to introduce Pat Radcharian, who is our head of financial products. Pat, over to you, my friend.
Thank you very much, Joey. And that was really brilliant and very, very awesome summary. Thank you. So, Joey, if you want to hit on to the next slide. So, I think just a little bit of background about me. I help run the financial products team here at GetGround, which is basically helping Joey and his team with other services that our customers might need. So as Joey mentioned, that we want to be able to help customers with everything on one platform. So that's not just a company formation, but we also help customers get to the right place in terms of mortgages, property management, furniture, etc. as well. But today we'd love to just get a bit deeper on the mortgages front, as it's one of the most commonly asked requests. More than half of our customers ask us about this. So I think we'll start with the very basics, and then we'll go a little bit deeper, and then at the end we'll touch a little bit about some frequently asked questions and kind of timelines that one should expect when trying to get a mortgage. So first off, what is a mortgage? I'm sure most of you guys are already well aware of what it is, but just for the sake of starting from ground zero, mortgage is basically borrowing money to invest in property, right? So instead of, if you want to buy, a £100,000 house, instead of paying the whole £100,000 upfront, you might be able to say put down 25,000 and then borrow 75,000. So then you would have a 75% loan to value. And this could be all the way up to $1 million and $2 million. You can borrow quite a lot in order to make sure that you don't have to put all your money in one place. And there are also 3 different types of mortgages. So one is like colloquially called resis. So basically your personal property where you live in. And there's a second one, is a personal buy-to-let, where it's a buy-to-let but under your own personal name. And then there's a company buy-to-let, which is a buy-to-let mortgage product specifically for companies. So maybe we can go to the next page, Joey. So I think one of the key things that we always get asked is, what rates should we typically expect? And why are rates for companies a little bit higher than personal? So we just wanted to make sure we spend time up front to talk about why they're different. So the first thing that you should expect is that rates for personal buy-to-let mortgages will range anywhere between 1.5 to 2% if you're of good credit. At times as well, you can go closer to 1%. Whereas for companies, typically this will start between 2.5 to 3%, but you can also get it as low as 2%. So, the first question we typically get, why is the interest rate different? And I think I'd like to go back to what Joey's mentioned about the benefits of treating mortgage interest rate as expenses in the company side, but it's very, very limited to do the same under the personal company structure, right? So just to reiterate what Joey said, that if you put a property inside a company and that company has a company buy-to-let mortgage, what you can end up doing is that all your expenses for mortgages can actually be fully expensed, and that could be that will help you from a tax credit perspective. Whereas the same logic is very, very inhibited on the personal side. So you're going to benefit very little in this front under your own personal name. So actually, when you look at the entire picture, if you treat your mortgage interest expense, you would probably be around 20 to 40% better off using a company buy-to-let mortgage rather than a personal buy-to-let mortgage. And that helps explain a little bit of the differences between the interest rates I've shown here. So I think it's very, very important for people when we start looking and start researching that you don't get put off by the difference in the interest rates, because it at the end of the day, it helps you from a tax perspective. If you want to go to the next slide. And then some of the really, really typical questions that we tend to get is on, when should I start this process? What does the process look like? How much time should I spend? Really, I'd like to break this down into 5 different components. I'd say that, we should meet with a broker as soon as possible. These are guys who are professionals in this area. They're very well versed with company formation. If you go through us, we will work directly with the broker on the back end to help pass on information to help you process the application as well. So it's something quite streamlined for you. But I'd say that the first stage is to meet with the broker, because they'll try to get to better understand you, and they have access to over 400 lenders to make sure that you get the best possible offer for any circumstances. The second stage is typically where you get a decision in principle, which will then show you how much you can borrow. Then you will submit a full application, which takes a bit of time, where you fill in information and fill in some forms. After that, the lender then takes a review of your application. And then after the lender approves your mortgage, then this gets passed on to a solicitor, who will then help you exchange your property. So there's a lot to digest. Maybe why don't we go through each component in turn? So Joe, maybe go to the next page. So let's just go over it. So let's say that, I'm looking to buy a, property in Manchester for around £500,000. I want to put in £100,000 and then I need to borrow £400,000, right? So I know that I'm doing that, and I'm looking at a property right now, and I want to better understand what I can borrow, how much I can borrow, and how much it would be, right? So then, for instance, I would then call Joey. Joey, hey, I'm interested in a company. I need help with the mortgage. What Joey will then do is contact one of our very, very close brokers who can help our customers from a company formation side. So let's say, it's Harry. I then chat with Harry, the broker, who will then sit down with me for around, 15 to 30 minutes and to really, really understand what I need. So I would tell him, hey, I need to look for something quite quickly in 2 months. I want something at the 80% LTV with the best interest rates possible, right? So now, Harry, okay, I got you. I understand kind of what you need. I will then go through with a process with Harry called fact finding, where I will fill in a very short form so that he knows a little bit more about me. And this could include things like CCJs, have I defaulted on payments before? How much income do I have? Do I have other properties? Am I a UK citizen, etc.? Because these things are critical to get information up front so that he can help me find the right lender. So this can take literally 1 day, right? It could take 20, 30 minutes in order to get that. The second part is typically quite important, is basically getting a decision in principle. This is when the lender, the broker, takes information that you've given them from the fact find process and then tries to find the best lender for you. And during this process, let's say it comes out and it's going to be Nationwide, it's going to be my best bet. I then say, hey, yes, go ahead. I like this Nationwide deal. And then what the broker will then do is to offer me a decision in principle. Typically, what the decision in principle will say is that I, Pat Roturan, has the ability to borrow up to this amount for this interest rate, right? This could also be an agreement or a mortgage in principle. So I think the question is, why is this important? It's actually quite helpful from an agent perspective, and when you're shopping for houses, is to have a decision in principle. I'm sure that, as we're all well aware right now, it's very, very hard to secure a property. And if you're able to show the agents and you're able to show the other homeowners that you have this piece of paper which says, hey, I can borrow up to this amount. I'm ready to go. You don't have to be, you're not taking on any risk that I can't afford this. I'm ready to go. You are much more likely to get the agent's attention to make sure that they pay attention to you. And second, that the homeowner is much more comfortable knowing that they are not going to take a risk that you won't be able to borrow. So it's actually really, really important that you get onto the stage before you begin your property search. So this stage can also take very, very quickly as well. It's typically up to the brokers. In my experience, you can get a decision in principle in around 1 to 2 days. So, but at the end of the day, it's all up to the, you as the individual and how fast you can provide that information. So let's say now you move on to the phase where your offer is now accepted on the property, meaning that the homeowner has now decided, yes, I am happy for Put to buy my property. What will then happen is that, remember, Nationwide as a lender will then take the dip, say, hey, okay, you have a decision in principle with me already. Please fill this in this application form, which will include a much more comprehensive question list. Like basically, can you provide your passport? Can you provide your driver's license? Can you please provide your income statement, etc.? And this is where the broker and GetGround can really help you fill in this information. And this full application process typically will take maybe around 1 hour or 2 hours to complete. And basically, once this is complete, this can then be submitted to the lender, and the lender will review. So maybe if you go to the next slide, Joey. And this is where, depending on the lender, you can potentially go into a bit of a black box, where the timeline of when you can get a confirmation whether your application will go ahead really depends by lender. But in my experience, in around 1 to 2 weeks, you will get a decision back. And most of the time, if your decision in principle is accepted, your application will also be accepted. So typically this phase is when, let's say, Nationwide comes back in 2 or 3 weeks time, say, hey, Put, you are good to go. I accept your application. Then you will then begin the mortgage offering and conveyancing period. This is the part where the lender has said they're happy to provide you the financing, and then you as the individual then starts what's called a solicitor phase, where the solicitor drafts up the document and then organizes the exchange of contracts. Typically, in my experience, it is best to make sure that you pick the right solicitor. What I would use this to depend on is, one is what solicitors your broker or your lender might recommend. And the second thing is that your solicitors have worked with some of the agents or the property development places that you're looking to buy. And this phase of solicitors typically can take, will take anywhere between 2 to 3 months to complete. But during this phase where there's a lot of demand for buying property, it could be a little bit longer than 3 months. So perhaps to wrap this all up, if you were to ask, okay, from start to finish, how long would it take? In my view, it can take anywhere between 3 to 6 months. But if you need a mortgage application to be submitted ASAP, this can be done, in my view, in around a month's time. It all really depends on you and how fast you can move in order to submit the applications and provide the information. Joey, maybe the next page. So I think, we wanted to also put in some key questions that we typically get from our clients on mortgages and some common misconceptions. The first question we usually get is, can a decision principle be issued without having a property you wish to purchase? The answer is, it depends. Some lenders will not require you to have a property at all, whereas some lenders will require you to tell them it is a specific property. In our view, it really doesn't matter what property you put on. You can also put on a property that you're looking at in a certain area that you're comfortable in buying. So let's say you don't know yet what you're going to buy, but you know that you're going to purchase something in Newcastle. You can put in a property somewhere in Newcastle in there so that you at least have a piece of paper that says you can borrow up to this amount, because that will definitely help on your property hunt. The second question we typically get is, why are buy-to-let rates advertised online lower than what brokers have quoted? We get this a lot. The first thing is saying that rates advertised sometimes online is not for limited companies. It's typically for personal buy-to-let mortgages. So make sure that you get that distinction right. The second is also, it's the lowest advertised rates is not available to all the borrowers. Because if, for instance, your income level is below X amount, your property is an HMO, or your property is a bit funky, or if you've had some defaults in the past, the lowest rates typically won't be available to you. So what I would highly recommend is that you spend time with a broker to make sure that they really, really understand your needs and your requirements and your restrictions, so that they can offer you the best, the lowest rate possible. Maybe just go to the next slide. And a typical question we get as well is like, what level of income is needed to qualify for a mortgage? And also, how can we define what income actually means, right? Yes, most lenders will have a typical income minimum. And typically this is anywhere between, let's say, 20,000 to 25,000 per year. But typically lenders are quite flexible as what it means to have an income, right? Imagine if you're retired, or if you're a student, or if you don't work, right? And so sources of income could include salary, self-employed income, other rental income, so other property income can also be used, and also pension income as well. It really depends by lender. And this one is probably one of the more flexible requirements that your broker can help you be creative and also be, what you can do here. And then the other question is, will having a bad personal credit affect my ability to get a limited company mortgages? The very quick answer is typically yes. So lenders, whenever they do a credit check on you, they will check if you have a bankruptcy in the past, if you had any county court judgments, any defaults, any arrears, etc., as that will negatively affect your ability to borrow, and your rates might be a bit higher. But rest assured, there will be lenders who can help you, but just to level set expectations, your rates that you would be getting might be a little bit higher. So maybe if we go to the next page. So this is just a bit about me. If you're interested in learning more, if wherever GetGround can help you, please just find my email here. But maybe I'll just take a pause here, Harry, to see if there are questions that I can help answer.
Thank you, Pat. That was very insightful. The first question is it more difficult to get a mortgage if you are an overseas buyer?
That's a great question. My answer is no, but international borrower rates are a little bit higher than UK resident rates. So the UK resident rates are anywhere between, let's say, 2.5 to 3%. International investors will start around 3.5 to around 4.5%. But in our view, in the past few years, the rate difference between international and UK rates are actually coming down. And I think this has a lot to do with recent surge of Hong Kong and Singapore investors coming into the UK. And they're typically very, very low default risk. And with international borrowers in particular, we have lenders like Gatehouse and a couple others who offer very, very competitive rates.
Fantastic, thank you. And if you haven't sorted out the mortgage, is it best to exchange contracts in your personal name and then change this later?
That would be very, very difficult, because then you would have to redo the process. My recommendation would be that, if you're meaning to already use a company, I would start with that. But if you've already gone quite far in terms of the personal mortgage application stage, I think it would be very difficult to change because one, you'll have to redo the application, which means you might have to repay an application fee, right? And two is that setting up a company when you're about, half a week or very imminently need to exchange on properties, that could get quite risky for the customer.
Okay, thank you very much. So I'm just going to hand it back to Joe now, just to finish off. So Joe, if you'd like to take it from here.
Yeah, great stuff. Thanks, guys. And look, I really do appreciate everyone sort of asking questions and things, and I hope that that's been useful for everybody. I think there was one question there from Kieran Phillips, which was, do you have access to planning consultants able to submit applications for change of use on a property? We don't. That may be something that we will look to do as part of our buy-to-let ecosystem later on. I would have thought that's something that you could typically do either with an architect or with a standard conveyancing lawyer should be able to submit change of use applications. And actually, I don't think the charges are particularly high as well, as far as I'm aware. We don't currently do that, but we'd be able to work with a lawyer if they did want to do that for you as well. I hope that that's been helpful for everybody. As I say, my name's Joe. I am the head of consulting here, and thanks as well to Pat, who is the head of financial products. Nothing that you've heard today does constitute advice, so I would say do seek independent legal and tax advice around your specific circumstances before actually deciding on whether this is right for you. If you do want to have a bit more of a chat with us, again, we'll be sending the slides round at the end of the presentation for you guys to get in touch. Alternatively, if you would like to navigate to our website, www.getground.co.uk, you will have the ability there to book in a consultation meeting, which is free of charge with one of our consultants to discuss your situation a little bit further. I hope that's been very helpful for you. It's been lovely to meet you all, and have a great rest of the day. Thanks very much.